Preparing to Sell, Topics and Tips for a Successful Transition was a live webinar that was originally produced on Thursday, December 7th, 2017. For this webinar, we were joined by two of our partners here at McKonly and Asbury, David Blain and Kurt Trimarchi. We hope you enjoyed this webinar recap, and please visit us online at www.macpas.com for more information about our future webinars and other events.
Dan, thank you very much. Welcome to today's webinar, Preparing to Sell, Topics and Tips for a Successful Transition. You should see on your screen right now two great-looking guys on that screen, specifically the guy on the left. That's Kurt Trimarchi, where we are honored and privileged, actually, today to have the managing partner of the firm on this webinar, Kurt Trimarchi. Kurt, anything you want to add there?
No, just say hi to everybody. Excited to be here and looking forward to spending the next 50 minutes or so kind of sharing some thoughts on selling your business and the things that we see in our life experience over the past couple of decades working on these types of deals. So go ahead, David.
Kurt, thank you very much. So just as a summary, the next webinar, next page there you will see is our webinar agenda and topics for today. We will be talking a little bit more about the key concepts in planning to prepare for business transition, and we're going to be looking at some preliminary planning and preparation for transition, things and topics in nature of things that you should really be considering and thinking about right now. Understanding business value. We'll talk a little bit about business valuation, how business valuation works, tax consequences, and some tax structuring matters to be aware of. And then we're going to talk quickly about any pitfalls and some unintended consequences that may come from going through a transition and transition process. So the big thing we want to start with and really keep in mind to start with is you really want to begin with the end in mind in any transition. And what that means is that you got to kind of know exactly where you want to be and what you want to get out of the transition at the end of the day, because that is going to be the catalyst for everything you do leading up to that potential transition, whether it's selling your business, transitioning it to next generation, or going through maybe a different type of business structure of an ESOP or something of that nature. You really, as the business owner, got to have an idea of what that's going to look like for you at the end of the day in order to be able to structure where you want to get to as you go down that road.
No, David, I agree with that. I mean, I think our experiences, and I was thinking the other day that collectively you and I have probably done in excess of about $20 billion in deal value. So we've had a good opportunity to see a lot of things from both the sell side and buy side. But I think the one thing that we would agree that we've learned is that the better planning certainly results in better deals, and that it's important, particularly when you're looking at planning on selling your company, that you really address these issues well in advance of a sale so that we can make sure that we address them and maximize the results depending on what they want to be. I mean, certainly you got to look at it from the primary shareholder's perspective and where they're at, where the company is in the life cycle. Certainly impact other shareholders, employees, management. And then, this stuff doesn't happen overnight. So you got to take some time to get there.
Yeah, totally agree with you, Kurt. I mean, I think you and I have seen enough deals in our time with organizations that we've worked with here in the past that have worked out really well. And then we've also seen opportunities lost, sure. I would say,
Absolutely.
Know what I mean? So. All right, so on to the next slide here. Going back to what we talked about, one of the first topic items was, what should we be thinking about right now, or what should you as the business owner be thinking about in advance of anything in regards to selling your business, transitioning your business right now? I mean, how can you best prepare yourself to be able to maximize the full value of your organization as you think about a transition? So a couple things come to mind as from our experience. Financial reporting is obviously a key item to talk about, just from the perspective of really understanding not just what your financial statements are, but a little bit more around some controls and everything. A couple other topics that we're going to talk about a little bit more detail here are going to be the team, making sure that you put the right team around you. Valuation, understanding value and understanding how value is determined, and just the structure of the deal in and of itself. So the first thing I want to talk about is really the team. When we talk about team, we talk about putting the right people around you to make sure that whatever you do is going to be successful. And three specific areas that team come to mind. First thing is your third party support. And what I mean by third party support is, you really should be thinking about the attorney that you want to use, and do they have the experience? Do they have the experience with transitions? Also looking at your business transaction advisor. I mean, I know a lot of organizations and a lot of business owners in the past, have feel like we can get this done ourselves and we can do this for ourselves. But I think what happens there is, but not having a really good experienced transaction or business advisor working with you, you do leave some value on the table at the end of the day sometimes, because
Absolutely.
this is not something that is an everyday occurrence for a lot of business owners. And the final thing would be is have, as part of your business and transaction advisor, having your accountant involved, having your CPA involved, or somebody who has a valuation experience or valuation background as certified valuation analyst involved with it. They could be also the business or transaction advisor, have those credentials or have that background, but having somebody that really understands like the tax concepts, the tax criteria, and the valuation perspective of the business to help you better position yourself into the future.
Sure, David. I think in my experience, as you know, as it relates to teams, obviously I also coach youth football, so I understand the concepts of putting together a team and making sure they're organized and go in the same direction. And if you do that well, you can get the results you want. So what I've experienced sometimes is we don't bring everybody together early enough in the process. So we're talking to our attorney, or we're talking to our accountant, or maybe we're talking to a third-party investment banker or somebody, and that's all part of the starting point. But the sooner that you can get your core team identified and ensure that they're all participating in the communication and the process, and identifying the objectives that we're all trying to achieve, I found that again yields better results. Oftentimes we'll start down a path too far if you don't have everybody at the table and some issue will be brought up or identified. It puts a hold to where you were going, and now it kind of disrupts the flow, and obviously it generally yields more time and energy from your outside advisors. And I don't think that's generally the goal of most of our clients anyway. I also think it's important for the internal team to really get a handle on right out of the gate how confident and comfortable we are in sharing from a sales side perspective that we're actually going to explore this transaction and where we're going. Very quickly, who do we identify is somebody that needs to be in that role, is pertinent to it, and that we trust to be involved. Obviously, we're always a little concerned about too much knowledge going to our competitors in the external market. So we want to kind of keep you a little guarded on who's involved. Other concepts to think about, certainly as you identify those internal team members, or do you have appropriate financial setups in place so that they feel confident that as they help participate in selling the company, that they have some financial protection should the buyer come in and decide not to utilize the existing team. And so a lot of times we'll see other kind of stay bonuses or other change in control type financial arrangements so that we can get those individuals very comfortable that, hey, put your time and energy in, you'll be rewarded as part of the deal. So whether you go that route or not, you definitely want to identify and make sure you get the right people involved early.
Kurt, that's a great point. And the other thing about your internal team too, I mean, we're talking a lot from the perspective of just outright selling the business to a third party, but even in the perspective of transitioning the business, where where as a business owner you may be selling your shares to another generation or next generation, or maybe even selling shares to other management team members. Still, again, having the right internal team around you that understands what's going to happen and what's going on, just so you protect key employees.
Absolutely,
is really kind of key. The third thing too is when we say other trusted advisors, what we mean by that is a lot of times you might have a relationship with a seasoned banker that is a retired banker and just has a lot of knowledge and a lot of wisdom, and you might want to bring them to the table. Or you have a relationship with a seasoned accountant or somebody that's been around the block. They somebody you have trusted for forever. it's okay to bring those types of people to the table, because a lot of times those people will be the ones that give you the best objective opinion about what you're doing and how you're going about doing things.
Agreed with
Yeah.
that, certainly.
So, all right. Next item is financial reporting. So as we're thinking about this process a little bit, one of the key pieces of information that any acquirer is going to look for is they're going to want to see financial data. They're going to want to see what your P&L looks like. They're going to want to see what your balance sheet looks like. Depending on the structure of the deal, I mean, assets may be a key part of the deal. They're going to want to see the value of those assets on the books and the condition of those assets. If it's a multiple of EBITDA, obviously, they're going to want to see what does free cash flow look like and how does the cash flow position look like. So having a really good understanding of what your financial statements look like and having a good feel for what those numbers actually are, I think is really key. And I think it comes down to the first item being really from the perspective of just having the right internal controls around your financial reporting. And those internal controls will be how quickly do you close the books? When do the books get closed? The reconciliations, how often does the reconciliation process occur? Is there the appropriate amount of reviews and sign-offs and check-offs on financial statements? And on top of that, what about like what we would call higher level reporting, financial reporting? What management's looking at the financial reporting? Is what kind of disclosures are around the financial reporting? I think having that type of key data available for an organization to be able to pick up and look at is going to give them more confidence as they go about the process of negotiating purchase price or negotiating a deal with you. Would you?
No, I agree with that. I think that's the financial reporting area in its entirety is one of those areas that I don't think we deal or address with quick enough in anticipation of a sale event. Frequently, I'd say we'd see with clients or people that we see in the community, their financial reporting departments are running adequately and or better, and doing the things that they need to do to manage their business affairs. But nobody's evaluating them from a sale perspective and what a third party might come in and how do they interpret how that financial department is operating. What is the quality and the technical expertise of the individual team members, and what does that internal control environment look like? And is it adequate to really garner the confidence of a potential buyer? And that's what you're trying to drive, right? We want confidence in the team. We want confidence in the data, because the greater the confidence from that potential third-party buyer, again, is going to drive better deal results. Also probably helps to accelerate timing on the timetable of a deal, because the less confidence they have, the more time and energy that third party is going to want to come in and dig down way into the weeds on every single thing. Not that in due diligence they might not do that anyway, but I mean, it gets worse or exacerbated by the fact that we don't have that confidence. So it's something that needs to be evaluated as early in the process in advance of a sale, because you can't flip the switch and tomorrow it's better. I know we highlight considering an audit as part of this financial reporting side. And again, you just don't hire somebody to do an audit tomorrow. There's certain procedures that need to be taken in advance. Sometimes we have to do more procedures if we weren't able to audit the opening balance sheet, because last year we did a review and we have inventory, as you know, David. And
Yep.
So now we got to take additional procedures and time in that. So that drives more costs and longer duration until we're able to get there. But it's important to know that a true third-party buyer may demand an audit. And we note here, like a financial buyer, private equity, venture capital types, they frequently will desire to see an audit in advance of buying, and that helps them gain that confidence. Well, again, you need to plan and think through that. We're not looking to drive additional fees when they're not necessarily unwarranted, but it's something you have to think about, sometimes 2 years in advance.
Right. No, I agree with you 100%. The other thing, too, to keep in mind, too, is quality of earnings. And what we mean by quality of earnings is really having a good feel for what your EBITDA and your cash flow look like. EBITDA being your earnings before interest, taxes, depreciation, and amortization, and how that drives your cash flow. Really, at the end of the day, a lot of these deals are driven by cash flow. I mean, really, cash is king.
Sure.
I mean, let's not kid ourselves. Cash is king. Most organizations, they want to see cash flow. They want to see cash flow right away. Because they have, if you're the buyer, obviously you probably have some type of debt structure or debt equity structure that you've got to deal with, and you're trying to pay that down right away, and you want to see some results out of your organization, out of the organization you just bought right away. So if you want to maximize your value in the business and try to get the highest amount of dollar out of the business as you sell the business or transition or whatever it might be, having a really good feel for what that cash flow looks like and what your EBITDA position looks like is going to drive multiples. It's going to drive maybe that additional cash that you're trying to get out of the business at the end of the day.
Sure. And you've done a lot of quality of earnings work over the years.
Yes,
I know
I have,
for a number of our clients, and you understand that that's not a in one day and out kind of process. There's extensive amount of time and energy when we're representing a buyer on that part. So representing the seller now is in advance. How far in advance do you think we should start thinking about how do we ensure that we have everything in order from a quality of earnings perspective?
Right, exactly. And, when we talk about quality of earnings too, I mean, there's a lot of times when you're looking at EBITDA and you're looking at cash flow, there's, we see it all the time in privately held companies that, there's things that are running through this financial statements that probably could be extracted out of those financial statements to give you a true view of what core cash flow would look like for the business after you extract certain things out of the business that may not be business related expenses. I mean, we've seen that before.
Sure.
So having that good understanding, because if you keep that kind of information in there, it might get hidden in those expense results, which is driving down the amount of cash that you could get out of a multiple.
Right. Absolutely.
So next slide, we talk about cash flow a little bit. So usually, cash flow is defined as the free available cash after all expenses have been paid. And expenses would include all operating expenses, including taxes, interest on debt, and capital requirements. So when we're talking about cash flow, we're talking about literally cash coming in, cash going out. What is the ultimate cash position of the business? Free cash flow does not include depreciation and amortization or what we would call non-cash items. Again, depreciation is really a book entry. Amortization is really a book entry at the end of the day that is required by GAAP. But for cash flow purposes, as you're preparing a cash flow statement, you're going to want to exclude those items from looking at your cash analysis and what the amount of cash the business is actually throwing off. So just the next slide, just a quick scenario that we put together, just as a real brief understanding. The first scenario, both scenarios look at the same thing. They're looking at revenues, operating expenses, taxes, interest on debt that you might pay in, and what you might have spent on capital equipment and capital assets. But the reason why these two scenarios are important is because one might look at scenario 2 and say, in scenario 2, my revenues, the cash coming in the door, my revenues are $2 million. And my scenario 1 revenues are only $1 million. So, one might think, wow, from a multiple revenue, if you were looking at revenues, scenario 2 is that looks like the most advantageous operation or organization. But really, at the end of the day, it's about what's driving the free available cash at the end of the day. So you look at scenario 1. Scenario 1 is actually driving more cash flow to the owner and to the business than what you're getting out of scenario 2. And even with scenario 2 being twice the amount of revenue from scenario 1. And I just wanted to show that calculation real quick and just to show everybody what we're talking about when we talk about free and available cash flow, because really that is what drives the multiples, and that's what's driving the multiples in a lot of the deals. So again, on this slide here, all we were saying on this slide here is that, from a valuator's perspective, scenario 1 provides more value, more free available cash from the business model than scenario 2, because again, scenario 2 might have more revenue, but scenario 1 is driving more free available cash. And we're going to talk a little bit more here about valuation, and we're going to talk about how different types of valuation methods. But some of the value could be impacted by discount rates, which we'll talk just a touch about here in a little bit. But the key thing on this slide, though, I want to make sure everybody's aware of. If there's two things you take out of today's webinar, it's got to be start with the end in mind, but cash is still king. It's got to be about what cash is being driven out of the business and what's free and available for whoever is going to purchase the business that they're going to have the ability to access.
I certainly agree with that, David. Better cash, better deal.
Exactly. The next thing I want to talk about real quickly is just valuation considerations. So why don't you spend a little bit of time talking about the valuation process, because this will have clearly a direct impact on whatever potential market multiples would be out there, or how the business is going to be viewed from the perspective of value.
Right.
So I just want to talk about what some of those valuation approaches are. Being a certified valuation analyst myself, in doing a number of valuations in the past, this is kind of some key pieces of the puzzle that a business owner really, a lot of times business owners won't pay attention to this a lot, but you really have to pay attention to how is valuation determined.
Sure. And I think this is an area personally where I see the least amount of focus before a sale. And I'd like to see more of our clients and more of the business out there spend a little more time understanding what their value drivers are. It isn't just about cash, although cash is king, but what are the things that really increase their value for their industry and their unique part of their business in that industry? What we do see is frequently an owner or management will come back from a business conference and they got somebody that sold their company for like 20 times so EBITDA multiple, and we know that didn't happen, but there's always somebody that sold it at a big number, and that's what we're certainly using for the value of our business. But we don't go through the process of really understanding, again, what drives value for our business, and how do we put processes in place then to ensure that we're taking steps that increase those value drivers, and that we evaluate those almost like we do our financial reporting data on a quarterly or annual basis.
Yeah, Kurt, great points across the board. I mean, you and I have both seen it before. How often do we get phone calls from people saying, I think my company's worth X.
Right.
And then you say to them, well, how did you come up with that value? Oh, I was talking to some other colleague of mine that's in some industry group of mine, and they said that they bought their business, or they bought assets from somebody else for X value, or they were told by somebody else that it's an 8-time multiple, and that's great, and that might be a good rule of thumb to work with, but every business is a little bit different. Every business has some uniqueness to it, and you have to take that into account as your determined value. And that's what we're going to talk about a little bit more here.
Sure.
Yeah, absolutely.
And having a realistic understanding at the forefront ensures that ownership has realistic understanding of or expectations of what they might get out of a deal. And that's important. You don't want to take a lot of time and energy going down a path towards a sale when their expectations are unreasonably high compared to what real results might be, and that creates a lot of frustration and a lot of bad deals.
Right, absolutely. So it's just what I want to do is just kind of go over some basic concepts on the valuation side. So what is it? What is a business valuation? And what that is it's establishing the value of an asset. But keep in mind, there's really in most businesses 2 types of assets. There's the hard asset, the tangible asset, the thing that the assets you can feel, things like what your accounts receivable is, what your inventory is, the equipment, the value of your equipment, if there's land and building involved. They're going to be your tangible assets, the assets that you see on a regular basis on any balance sheet. But then there's also going to be those intangible assets, the intangible value of some of the assets. And they're going to be things that you might not be able to touch and feel, but they're there. Things like goodwill. Goodwill could be just the name idea of the business. Maybe the business has been around for 75 years. It's got a great name in the marketplace. There's value to that because people come to that business because of the name.
Sure.
Trademarks, if you have trademarks of any sort, things that you have developed, patents that you have developed that you were able to trademark, that those items have value because there's only certain trademarks and patents that are out there based upon what is provided to you by the government, that gives you value because it sets aside a certain amount of time that you can use that trademark or that patent for some reason that nobody else can. So
Right.
That gives you some value. And then things like a customer list, we sometimes lose sight of the customer list. But if you have customers that in your business that come back constantly year in and year out, because of the name idea that you have or because of the product that you sell, there's value to that customer list. And,
Sure.
and a lot of organizations are that's kind of a key thing that they want to buy that's driving cash flow. So when we talk about establishing the value of assets, I just want to make sure that we've talked about those the tangible assets, but there's also value in a lot of intangible assets as well.
Yeah, and I think the process also ensures that you have clean ownership of those trademarks or patents, or your customer list clean. Goodwill, is it business? Is it enterprise and owned by the business, or is it goodwill reside at the individual shareholder or partner level?
Right.
Different industries have different answers in that. I know our tax department, there's some planning opportunities depending on who owns that goodwill. There's some pretty landmark court cases out there in that space, but it's an important process. And again, things you want to identify early so that you structure and negotiate deals in your best interest.
So what we want to do is just talk about the three key approaches in establishing value. The first approach is a pretty simple approach. It's called the asset approach. And typically in an asset approach, when evaluators looking at a business and they're establishing what the value of the business is, they're looking at what does the balance sheet look like as of a period in time, and then we are going to adjust the assets on that balance sheet for what we consider to be fair market value adjustments. So a good example here, Kurt, would be fixed assets, equipment assets. A lot of times, businesses will get those fixed assets appraised before, to get a good feel for what is the appraised value of these fixed assets, because that's going to be the fair market value or the value of those assets on the market if you were to just sell them individually. And what you see on most balance sheets, because most balance sheets are driven by cost, they're going to be assets that were bought at cost less accumulated depreciation. So that's really not going to give you what is the real value of these assets if you took those assets to market. So that's what we're talking about when we say an asset approach, where we're looking at the balance sheet as a point in time, but we're adjusting that balance sheet for what we believe to be the fair market value of certain assets. And even on the liability side, there's sometimes liabilities that are on your books but have an adjusted value that might be higher or lower depending on what the liability is for.
Sure.
So having that right adjusted balance sheet to really look at, to give you a good feel for what is the true equity of the business at the end of the day at a fair market value approach. That's what an asset approach does.
And again, sometimes we'll get caught up on the discounted cash flow and so focused on earnings and ignore the fact that maybe we have a business that's heavily owns a lot of real estate, and maybe it's old real estate on the books, so it doesn't show a lot of value from a financial reporting perspective, but from a deal flow might actually be a bigger driver in the overall value of that business.
Yeah, Kurt, that's a really good point, because from a evaluator's perspective, the evaluator's responsibility is determine the highest and best use of the assets. So you might use, like you said, we talk a lot about cash flow and market multiples, but you might find that the highest and best use is actually an asset approach, where it's the fair market value of the assets because they provide a higher value for you than the actual cash flow stream.
Right.
So that's why you look at these different approaches, because those different approaches are going to drive what the ultimate real value of the business is. Second item we want to talk a little bit more about is the market approach. So the market approach is the one that you kind of see a little bit more often when you hear people say, market multiples in our industry are 8 or is an 8 multiple, or it's a 7 multiple, or 6 multiple. And what we mean by the market, when we're looking at the market approach, what happens here is we're looking for comparable data. As a valuation expert, you're looking for comparable data in the same industry, transactions that may have been done, and those transactions should happen within a certain period of time, within maybe the last couple of years. You don't want to look at transaction data from 10 or 15 years ago. You want to look at something that's happened in a more recent market and try to kind of get a feel for, what was that market multiple price at the end of the day when you look at EBITDA or cash flow versus what was actually paid for the business. And that will kind of give you a better feel from a market approach. If you were go to market with your business, what is that multiple you might be able to get for your cash flow stream or for your earnings before interest, taxes, and depreciation and amortization.
Right. Hey, so from a market approach, certainly if I'm sitting here as a potential seller, I understand as a public company, there's a lot of public company data. But of course, we're sitting here where we reside. Most of our clients are privately owned, closely held businesses. So I guess if I'm a potential seller, my question is, David, how easy is it to get market data when comparable to me as a privately owned company?
Kurt, that is a great question. And the reality is there's not a lot of good quality data out there for privately owned deals. There's just not, because if you think about the essence of a private deal is just that. It's a private deal. Typically that information is not disclosed. Typically that information is not translated anywhere, versus a public company deal where it has to end up in a 10K or a 10Q, and that information has to show somewhere where you can easily identify it and read it. Private deals, you don't see a lot of that, and that makes it difficult from the evaluator's perspective to really get good data to really make a comparable review of transactions.
Yeah.
So it's you don't have a lot of data out there. There is data you can find in areas like Pratt Stats and BizComps and stuff like that will give you some data, but private deals are difficult to try to find good transaction data.
Okay. Thank you.
The last approach, which is the most common approach we see actually in private deals, is an income approach where, as we talked about a little bit earlier before, you're looking at cash flow and you're looking at EBITDA. Now, in your income approaches, there's two primary methods. There is the capitalization of benefits method, and then there's the discounted future benefits method. So what's the difference between those two? Really, it comes down to this. If you're using a capitalization of benefits method, it's usually typically an organization that has a pretty stable revenue stream, a pretty stable income stream, and you can see that through history. You can go back to the last 3 or 5 years of financial statements, and you can see a pretty stable income stream and a pretty stable benefit stream coming out of the business. In that instance, you would use what we would call more of a capitalization of benefits method. You look at cash flow, you look at EBITDA, but then you're going to look at what's the discount rate on that, and then what's the capital rate percentage that you're going to use against that. Discounted future benefits method. Now that's going to where you're looking at a business that is typically in a growth trend. So you're going to want to look more at prospective numbers than you're going to want to look at historical numbers, because what you're saying in a discounted future benefits method approach is that the revenue stream and the income stream is not really stable, because you're expecting revenues to grow because of some certain line of business that you're putting in place. You're going to expect cash flow to grow and income to grow because of the new line of business that you're putting in place. And what you're doing literally is you're selling the prospective cash flow and the future cash flow of the business discounted back to today's dollars. So that's kind of the difference between those two methods. But typically what we see mostly in the transactions that we do is really income methods, whether it's a capitalization method or a discount cash flow method.
So would you say it's safe to say that at least a starting point for a deal, probably for a buyer looking at my business, they're probably going to look at it from an income method, cash flow perspective?
It all depends
and how they approach it.
Yeah, I would say it depends on the industry. I mean, if the industry is heavy capital intensive, asset intensive, they might want to look at the assets. But I think in the majority of industries, the income method, or looking at some of these income approaches, starting with what your cash flow and EBITDA are, and then looking at it from a capitalization or a discounted benefit method, that's really ultimately at the end of the day what we're going to see the most often.
And if we think maybe there's another methodology under the asset approach, though, it's probably on ours as a seller to really put together a good pre-sale book to show how we're getting to that value, why we think that's a better approach specific to our business, because generally we're going to start in the cash flow and go from there. So if we don't think that's going to maximize our deal, we need to identify that early on, right? And then ensure we're putting in some good materials and finding potential buyers that understand that approach,
right? Instead
of wasting a lot of time and energy for a lot of people.
Absolutely. Absolutely, Kurt. Great. All right. So we're going to talk now a little bit about some of the pre-owned ownership structures and things that we want to take a look at from that perspective. Well, first thing would be, review. The first thing you want to really do is you want to review your current ownership structure for planning opportunities and risk management. And, it's just kind of look at what is some of the, are you an S corporation? What is the structure that you are, and how is that going to impact what your deal structure is going to look like?
Yeah, again, this gets into better planning equals better deal results. And I'm going to say, obviously my background in the transaction space, heavy tax, given that's where I started my career many years ago with Arthur Anderson and kind of evolved from there. and the tax area is certainly one of the areas that I think I've seen the most, I don't know, I'll say improvement, but more time and energy in deals being spent in that space. So it's important that you get a good handle on these issues for yourself as a potential seller well in advance. When we talk about ownership structure, planning opportunities, one of the things we're talking about is, maybe it's a sole owner right now. 100% of the company is owned by mom or dad or both, whatever, but mom and dad own the business. Is there an opportunity in advance of a sale to transfer some of that ownership to next generation, if that's a desired result from a income tax perspective and or from an estate tax play, depending on what those rules are at that time and what they may be in the future, depending where future legislation takes us in the next year. But it's not something you show up the day of this, a month before sale and start moving ownership around. This again an opportunity to do different planning. Where we see it around the country is sometimes in trying to look for jurisdictional shifting of ownership, so that maybe we can see a potential sale of a company, stock sale of a company pulled out of a high tax jurisdiction, say like California at 13%, and move it into a lower or zero tax jurisdiction state, and maybe through the use of a trust vehicle as one of those things. Again, there's plenty of opportunities here to look to try to maximize your after-tax yield, but you got to do these things, not the day before. Also, we see more and more scrutiny on just the validity of the tax positions or the tax structure of a company. Trust space, again, we do a lot of work in the trust arena, and we'll see, and we've seen this where sophisticated buyers or sellers, but the buyers are coming in and they're really scrubbing old trusts to ensure, or even new ones for that matter, but are they operating in accordance with the rules, or have they done something? If a trust owns stock of an S corp, have they done something that creates a potential problem to the validity of that S structure? And now we have a whole deal structured around, we'll talk about that in a minute, that may be dependent on us being a valid S corporation, and we find out in the middle of the deal we're not a valid S. Is that going to slow down the deal? Is that going to terminate the deal? Do we have to restructure to our detriment because we end up with a worse result? These are things that I would recommend you want to know well in advance before going to market to sell your business. So there's a number of steps that we can go through there, or you should be going through as a potential seller. Entity type, we always, with where current legislation is, some of these analysis might change in the future a little bit. But again, if we're historically been a C corp and we think that that's not the most tax advantageous structure for a sale, because a potential buyer is going to want to come in and do an asset purchase in our business, so that they could get basis step up and help subsidize the cost of their transaction. And now we're sitting in a structure that's going to create a double layer of tax, one at the entity level and two on liquidation or distribution of those sale proceeds. Maybe we're not in a tax efficient structure. How far in advance do we need to make some conversion so that we try to minimize the impact of that or reduce it completely? And those are things you need to have answers to. Again, that could take 5 years. Back in the day, 10 years. It takes some time. Partnerships. If you're structured as a partnership, and we'll get in the weeds a little bit, but let's say you're a cash basis taxpayer, you go to sell your partnership. Well, now you have to look at this concept called hot assets. And that may recharacterize a certain amount of the gain from a capital gain into an ordinary perspective. And, in the current world, that's a 20% delta in tax rates potentially. That's significant. Well, is this something we could restructure from partnership to S corp 2 years in advance? And can we eliminate some of that potential burden? All questions that should be being asked, but again, better planning, better deal results. And these are the process that I think that all of our clients should be going through.
Excellent. So we were talking a little bit about different types of tax structures and what is that and what that means to me. We talk about traditional structures of when we talk about doing these deals, asset deal, stock deal, how a 338H10 election impacts a deal. I mean, Kurt, from your perspective in some of the deals in the number of deals that you've been involved with in the past, can you extrapolate a little bit more on these traditional structures and how they impact you from a seller standpoint?
Sure, and this is the plain vanilla version of some traditional structures, and probably assuming that as a seller we're selling for cash or cash in a note, not necessarily cash in stock if we're selling to a public entity or some other structure. So we're keeping it pretty simple here. But my experience has told me one thing. Seller will be advised that they should sell stock because that gets them a better tax rate. Buyer's been told they should buy assets because of the basis step up I had mentioned earlier. And that's where everybody starts every deal. The reality is we should be able to negotiate out to a deal that works for both parties. If I'm involved with representing somebody and they want to understand the stock deal and we get to some kind of purchase price and what that looks like and what the after-tax results are for a seller, we can work with buyer to say, all right, well, in an asset situation, maybe we can find a premium, go up from that stock, the amount that you suggested you would buy the company for. We can get a premium. That premium gets us to a similar after-tax yield or a better result as a seller, but it gives you the opportunity to get significant basis step up in the fixed assets or tangible assets of the business, which may yield tremendous tax benefits for you as the buyer down the road. So I think the thing that I want to talk to people today is just simply to say, look, there is no, it's absolute this or absolute that. And if you're involved in a transaction, I would hope that you would, especially as an advisor, be telling the people at the table that, look, let's figure out one structure and then we can negotiate to another and see if there's a way to get there. And that's an important thing. The 338H10, just for those that may not know what it is, basically is a tax code. And it's simply, for all other purposes, the legal transaction is going to be structured as sale of stock or sale of LLC units. But the deal itself, for tax purposes, is seen as an asset deal. And we'll see that in certain industries where we need to preserve the legal entity structure because we're in healthcare, we have Medicare provider number or some other thing where we don't have the luxury of buying the assets and then restarting the clock and reapplying to be able to provide those services. It's too long of a time lag. It impacts the overall business operations and the viability of the deal. So we'll look to do something legally so we can maintain certain attributes of the business, but still look to get an asset result if we can. Again, all this is stuff that we would address in a pre-sale conversation, try to get a model out in advance of what that after-tax looks like for a seller, and allow them to have a good sense of where we're going in long before we go to a suitor and say the potential suitors and say who what kind of deal can you bring to us. We're going to know what our different answers are likely to look like depending on the facts of a deal.
Yeah, 338H10 elections, you do see those a lot in insurance type of deals because of the fact of, like you said, you can't. It's not like you can stop. You buy an insurance policy, it's not like you can stop today that policy. I mean, right. The policy has a period of time. It started at a period of time, it ends at a period of time. So you do see that on a regular basis in those types of industries as well. Transitions within a family. I mean, that's also something you got to keep in mind too. When we're talking about how we structure a deal and different types of in the different types of structures that you can see. If you're transitioning to the next generation or to the third generation or whatever,
sure,
whatever you're trying to do.
And I'm very lazy with this slide, so I just put a couple letters on without giving anybody understanding. But basically, we're looking, the first three are various types of trust vehicles that are used frequently in family transition. Obviously, the fourth one is just an outright gift from one family member to another. The reason I just wanted to highlight this very quickly is simply, again, in a pre-sale planning that maybe at some point early on, if we're just looking for a liquidity event for a seller like mom and dad as part of transition, there's some tax efficient opportunities here to transfer wealth or ownership to next generation in a tax efficient way so that I convert stock in my company to now cash for mom and dad. But also it could be part of a larger pre-sale deal down the road that ultimately a combination of these two results can really lend to a positive outcome for the overall family from a financial and estate planning matter. So again, when you're thinking sale, don't forget to include your estate planners in that conversation well in advance to see if there's an opportunity to do some advanced structuring pre-sale so that you can maximize both your income tax and your estate tax results or right. Just asset protection or wealth transfer in general.
Right.
So that's all I really wanted to highlight there.
Good. Now let's talk a little bit about, pitfalls and consequences of decisions that you might make. The first one we talked about a little bit earlier, just kind of brief that we kind of scraped across it. But quite honestly, this is very important. And that is, as the owner of the business, be honest about your business. And what I think what I think we mean by be honest about your business is, I can't tell you how many times I've seen overinflated thoughts of value in the business owner's mind.
Right.
And you know what? I can totally understand it, because, if you're a business owner, a lot of these individuals that we work with, they've owned their business for 20 or 30 years. This is the only thing they know.
Sure.
You know what I mean? This is their business. So they, of course, are going to have a thought in their mind about what the true value of that business is. But it's important to be honest about be honest about what your business is all about and the value that your business is actually worth. And the reason why I say that is because at the end of the day, you don't want to lose opportunities in transitioning your business because of an overinflated thought in your mind about what the business is worth.
Yep. That
goes back to the whole idea of making sure you got good financial statements. You really understand the market. You really understand the industry that you're in and who you're competing against. And talking to those in the industry as to, what are they seeing in market multiples and what are they seeing and understanding. But, have an honest opinion about it in regards. Use highly qualified professionals.
Yes.
So, we talked a little bit earlier about making sure you put a good team of third-party professionals around you, but also internal professionals around you to make sure that you can maximize the value out of your organization or your business in any transition. And making sure that you use the right professionals is really key here, because a lot of times people think, well, I'm just going to use my CPA. Well, some CPAs, that's not what their specialty is and their expertise is.
Sure.
Some CPAs, their expertise might be in tax, or it might be in audit, but it might not be in transitions of this type or deal structures and working with other third parties. So making sure that you have the right highly qualified professionals around you. It's kind of like, you pay me now or pay me later type of thing. It's better to have the right professionals in place. It might cost you a little bit more, but if they can increase your value 1 or 2 times what you thought it was going to be,
right,
then it's kind of worth it.
I think that's one area that I think a lot of times is the biggest problem or negative in a deal where people do not drive results that they could, is that fear of writing the check up front to qualified professionals, whether CPAs, attorneys, investment bankers, other deal specialists. The idea that we're going to save that money usually ends up in a worse result, in my opinion. And when you have highly qualified people that can get you access to the right markets and the right potential buyers so that you can maximize that deal. I mean, you could see it.
Right.
Some multiples of what you think you may be saving. You're probably losing multiples of that number, and that to me is definitely a number one problem when we're not maximizing deal for seller.
Right. Next thing too is we say communicate. And what we mean by that is communicate. Making sure that your team of professionals, your internal team, totally understand what the end game is. That your professionals understand what's going on within the organization, so everybody's communicating the same story. And going back to being honest about your business, that part of that is communicating with the acquirer to make sure that you're communicating the fact pattern of the business and how the business is running, and giving them the full picture and understanding about what's going on with the organization. A lot of times I've seen deals blow up because certain information was withheld or certain information wasn't provided. And then what that caused is the acquirer to lose confidence.
Sure.
You know what I mean?
Sure.
So, and then the final thing is, again, as we talked about at the start, just begin with the end in mind. Just a lot of times business owners get attracted to somebody came to them, that significance factor just got hit because, hey, you know what? This organization's approaching me. They're excited about my business. Yeah, let's talk about selling the business. But you know what? If you don't have an end game in mind, or you don't understand what you want to do with yourself as a business owner into the future, sometimes you're going to get down. You get down that road, you get down that path, and you start to realize that, well, wait a minute, this is the path I want to go. So start with the end in mind as to what you want to do and how you want to get there. what that approach is going to look like.
Sure. And I think speaking of the end, I think we've made the end of our presentation. So appreciate the opportunity to speak today. And before David, I'm sure you can wrap up or ask for any questions. It's just selling the companies is an exciting and nervous part of any family's life cycle for private or closely held businesses. And again, you take the time and energy to make sure that you do it right, because you're only going to do it once.
Yeah, and Kurt, we hit a lot of subject matter here in 50 minutes, and that's one of the reasons why we only focused on the sell side. There's going to be a second webinar for those in webinar land that are interested. It is going to talk a little bit. The second webinar, which will be in probably the first quarter of 2018, is going to be talking about buy side and being on the buy side, and the things that you should be looking and thinking about on the buy side, and how to go about the due diligence process and the quality of earnings process on the buy side. So everybody will hear a little bit more about that going on here, and if later this month and early next month, as we begin to advertise that for the buy side activities as part 2 to this webinar. So,
thank you once again for joining us for this webinar recap produced by McKonly and Asbury. We hope you join us for all of our future webinars. You can stay connected to us and learn more about all of our upcoming events by visiting www.macpas.com. Thanks again, and have a great day.